Hey guys, so in today's video, I'm going to be teaching you a super simple Forex trading strategy that you can use to start passing your funded account challenges and most importantly, getting those huge payouts. Now, this isn't a strategy that I've randomly made up. It's one that I've used to pass funded account challenges myself. I mean, here's a 200K account that I passed literally just last week utilizing this exact same strategy. Now, it's very simple. It requires three core concepts, and once you learn these, trust me, you're going to be able to start hitting these big trades to pass the challenges and get these huge payouts in 2026. So first and foremost, what we have to do is start off on the higher time frame and understand where we are in terms of our structure. Now that is number one. That is key. You have to know where you are in terms of the overall structure. Now it may sound hard if you're fairly new to trading, but trust me, it's something that you're going to pick up relatively quickly. So let's quickly take a look at this chart over here. Now, what do you think is happening? Are we going up or are we going down, right? That's the core premise of structure. Up, down, sideways. Well, in this clear structure right here, what we can see is that we are going up, right? We're creating a higher high. Then we've come down and created a higher low. And then again, we've pushed to the upside and created a higher high. Now, following that exact same structure, what we expect is something like this, where price comes down and gives us a higher low. And then we expect something like this, where then price will continue higher, right? Simple bullish structure. So now that we understand where we are, that is component number one, understanding our structure. So in a bullish market, we expect price to, like I said, come down and then go higher. So what we're going to do is try and catch the area where price is going to come down so that we can then ride that move to the upside. Now, obviously, if we was in the opposite direction going downwards, then it would be flipped on its head. But I'll show you another example of this later on in the video. But for now, we're bullish, and that is very good. So next, we have to identify key areas of interest. Now, areas of interest can come in all different shapes and sizes. We've got fair value gaps, we've got order blocks, we've got inverse fair value gaps. There's loads of different concepts. Now, for me, I like to keep my life simple and I focus on two different things: order blocks, fair value gaps. Now, for this video specifically, I'm going to be teaching you about fair value gaps. If you want to learn about order blocks, go and check out some of the other videos on my channel. They'll teach you exactly what you need to know. But when we take a closer look into this price action, can you guys spot where the immediate fair value gap is? Now, if you haven't done so already, I'm going to give it to you anyway. It is right here. So we've got this bullish fair value gap. Now, if you're new to trading, again, you're going to be probably asking, what is a fair value gap? And it's very simple. Price likes to be in equilibrium. For every buy, there is a sell. For every sell, there is a buy, right? Understanding that concept, price likes to keep itself balanced. So that means every time there's a buy, somebody has to sell. Every time there's a sell, somebody has to buy. When that does not happen, we end up creating this void, this place in price where only one side was offered and the other side wasn't. Now, in this bullish example, within this candle right here, we only had buys offered, no sells, which means we left this gap. You can see that there is a gap from this candle's wick to this candle's wick. The first candle to the third candle, there is a gap in between. Now, this gap signifies that there is imbalance in price, not balance. So we can actually utilize these areas because price is going to be magnetized to this area because it wants to balance itself again, right? Which is why these can sometimes also be called an imbalance because price is no longer balanced. So with that understanding, we've now just covered our core concept number two, which is identifying points of interest. So we're bullish, we're finding bullish areas of interest that price can potentially come back into. And when price comes back into these areas, we move on to our core concept number three, which is our entry schematic. How do we know that price is actually going to reverse from this area? So for that, first, we're going to wait to see if price actually comes into this area. And once it does exactly like this, we're going to drop down to our entry time frame. And for me, that is going to be the 5 minutes. Now, on the 5 minute, what we're simply going to do is, again, follow the exact same principle that we did on the higher time frames with our structure. So in this current example, what we can see is that we are bearish, right? At the moment, we're creating a low, Then we had this lower high, price then again pushed to the downside. We then created another lower high, and then price again pushed to the downside. So our market structure is telling us that we are bearish. Now, since we've tapped into this higher time frame area of interest, we now want price to flip from bearish to bullish, because that will indicate to us that we are now looking to go higher, right? Very simple. It's the exact same thing we were doing on the higher time frames. So if we follow structure and this becomes our lower low, lower high, and lower low, if price goes and breaks above this lower high right here, that would signify to us that we've now flipped from bearish to bullish, and we can expect price to then rally higher, right? We're simply just following structure. So for our entry schematic to play out, we need price to break above this previous high so that we get that market structure shift. And this is our core component number 3, understanding our entry schematic. So if I now play price on, what we can see is that after a while, price actually comes and breaks above this previous lower high. So now we've indicated, or price has indicated to us, that is now looking to go higher. So with that understanding in mind, we're now again going to do the exact same thing that we did on the higher time frame, and that is to identify our fair value gap, because that is where we're going to be taking our entry. And again, I'm sure by now you can immediately identify that there is a fair value gap right here, because again, the first candle's wick does not overlap with the third candle's wick, leaving this imbalance in price. And like I said, price likes to be balanced. So what we're anticipating is if we take our entry for this trade at the open of this fair value gap, we can safely put our stop loss just below the low down here, and we can potentially target a brand new high, right? Because we're expecting on the higher time frames that price is going to rally higher. But what I like to do is make sure that I always take profits early, because the markets are unpredictable. So what we always want to do is take profits. We don't want to leave money on the table. So first and foremost, we can see that we've got our London highs right here. So that would be our take profit number 1. And then we've got the Asia high up here, or our brand new high as well. So price can potentially also push up to there as well. So this is how we've now taken the higher time frames, put them in conjunction with the lower time frames, and framed a trade in line with the higher time frame direction. And this should give us a relatively easy trade. If you simply just follow this concept over and over again, trust me, you're always going to be able to hit those nice trades, because you've got a framework. You've got a plan in place to make sure that every trade is the same. And that is all that it boils down to. Trading is simply a reflection of your discipline in the markets. So having said that, this is the trade that we've now framed up. And if I play price forwards, what we can see is that price taps us in, right? And then after that, we slowly start to build our way higher. And what I like to do is make sure that I'm always managing my position as efficiently as possible. So once price starts moving higher and breaking structure, I will then go break even. Or in this case, I'll move my stops just below that low, and then price continues to rally higher. So in this case, I will then move my stops to break even. Once we break this high just above the London high, I will start taking partials, right? I will take money off of the tables. I can bank some just in case price turns around, especially in these current market conditions where one tweet from Trump or some geopolitical event happens and price is just going to do all sorts of things. So in conditions like this, also during holiday periods, you want to make sure you're managing aggressively, taking those profits as quickly as possible, banking them so you can start getting those payouts. But having said that, this is all that we do. Follow those 3 core concepts to make sure that every single trade is the exact same, you're in line with the higher time frame, and that every single trade is following the same footprint. Because then overall, you're going to be a much more profitable trader, a much more disciplined trader. And that is pretty much going to wrap it up for this video. I hope you guys did enjoy it and gain some value. If you did, please don't forget to leave a like, comment, and subscribe. And make sure that you're always following a set plan for yourself in the markets. Because like I said, a disciplined trader is always going to be a trader that is making more money than somebody who comes into the markets and randomly sprays and prays on every single trade. That person is most likely never going to pass an account. Maybe they'll pass one. But the person who's disciplined, following a plan, and treating this like a business is going to be able to pass their challenges and get those huge payouts in 2026. So make sure you're not repeating the same mistakes that you did in 2025. Make sure you have a plan, and make sure you understand what you're doing when you're in the markets. If you struggle with any of that, then click that link down in the description. I'll be more than happy to teach you everything that I know. Well, apart from that, I hope you guys enjoyed this video. Like I said, don't forget to leave a like, comment, and subscribe. And on that note, I'm gonna catch you guys in the next video.